Hello, I'm Grace. Global financial markets are on high alert as an unprecedented surge in interest rates, the likes of which haven't been seen in 20 years, hits the U.S. bond market. According to recent reports, the yield on the 30-year U.S. Treasury note has breached the 5.2% mark, following a steep upward trajectory. The severity of this spike lies in the fact that it transcends mere numerical fluctuations, climbing to levels not seen since just before the 2007 financial crisis. Market indicators reflect this volatility, with 10-year Treasury note futures dropping by 18 ticks, signaling rapid shifts in both bond prices and yields. The fact that long-term yields have reached such heights suggests that the market is experiencing extreme uncertainty regarding the future economic path. Surpassing the records set in 2007 indicates that the current high-interest rate environment may be a structural shift rather than a temporary adjustment. The simultaneous occurrence of rising yields and falling bond prices serves as a signal that investors are fleeing from bonds, traditionally considered safe haven assets. This implies that the era of low interest rates has come to a definitive end, exerting powerful pressure that forces a repricing across all asset markets. Even if corporate earnings remain robust, there is a high risk that such gains will be offset by the massive wave of rising interest rates. In fact, even Wall Street optimists are warning that the uncontrollable power of interest rates will overwhelm corporate profit growth. When rates rise, corporate financing costs increase immediately, a structure that ultimately leads to diminished investment and weakened profitability. In particular, the surge in long-term yields inevitably exerts fatal downward pressure on growth and technology stocks, which rely on discounting future values. This phenomenon goes beyond a mere response to inflation. It reflects fundamental doubts regarding market credit risk and economic growth prospects. Ultimately, this situation proves that the macroeconomic interest rate environment, rather than corporate fundamentals, is the key variable determining market direction. As interest rate volatility is likely to act as a downward risk for the overall economy, the market's resilience will be put to the test. Since the trajectory of U.S. Treasury yields serves as the benchmark for global asset allocation, upcoming economic indicators must be monitored with extreme caution. I'm Grace, thanks for watching.